What are mutual funds and how do they work? A mutual fund is a type of financial business that pools money from many different investors into one enormous pot. The fund's professional management invests the money in various assets such as stocks, bonds, commodities, and even real estate. A mutual fund shares are purchased by an investor. These shares indicate an ownership stake in a component of the fund's holdings. Due to their fee structures, mutual funds are created for long-term investors and are not meant to be exchanged regularly. Because they are extensively diversified, mutual funds are generally appealing to investors. Diversification helps to reduce an investment's risk. Rather of researching and deciding on each sort of asset to include in a portfolio on an individual basis, mutual funds provide a single, complete investment vehicle. Thousands of diverse assets can be found in certain mutual funds. Mutual funds are quite liquid as well. Mutual funds make it simple to acquire and sell shares. There are several mutual funds to choose from. Bond funds, equity funds, balanced funds, and index funds are just a handful of the primary fund kinds. Bond funds invest in fixed income securities. The holders of these bonds are paid interest on a regular basis. The mutual fund distributes payouts to this interest's mutual fund holders. Stock funds invest in the stock of a variety of firms. Stock funds aim to earn primarily from share price gain and dividend payments over time. Stock funds frequently invest in firms based on their market capitalization, which is the entire monetary worth of their outstanding shares. Large cap equities, for example, are those having a market value of more than $10 billion. Large, mid, or small cap equities may be the focus of stock funds. The volatility of small cap funds is higher than that of large cap funds. Mutual funds and how they trade. Mutual fund trading differs from trading ETFs and equities in terms of mechanics. Unlike stocks and ETFs, where the minimum investment is one share, mutual funds need minimum investments ranging from $1,000 to $5,000. Mutual funds only trade once a day, after the markets have closed for the day. During the trading day, stocks and ETFs can be exchanged at any time. The net asset value, NAV, computed after the market closes determines the price of mutual fund shares. The NAV is determined by dividing the entire value of the portfolio's assets, minus any liabilities, by the number of outstanding shares. Stocks and ETFs, on the other hand, have prices that change during the trading day. An investor purchases or redeems mutual fund shares from the fund directly. This is in contrast to stocks and ETFs, where the counterparty to the purchase or sale of a share is another market participant. When you purchase or sell shares in a mutual fund, you will be charged varying fees. Fees and charges for mutual funds. Investors must be aware of the various fees and charges involved with purchasing and redeeming mutual fund shares. These fees vary significantly and can have a significant influence on the success of a fund investment. When buying or redeeming shares in a mutual fund, some levy a load fee. The commission paid when purchasing or selling a stock is identical to the load. The load fee rewards the selling middleman for their time and expertise spent assisting the investor in picking the appropriate fund. Load fees might range from 4% to 8% of the total amount invested in the fund. When an investor buys shares in a mutual fund for the first time, he or she is charged a front-end load.